Ever wondered how businesses manage their finances? How they keep track of what they own, what they owe, and how much they are making? It all boils down to some fundamental accounting concepts. Imagine a business as a giant puzzle, and these accounting concepts as the pieces that fit together to give us a complete financial picture. Let's delve into these pieces one by one. First up, assets. Assets are resources owned by a business that provide future economic benefits. Think of it as anything that puts money in your pocket. For instance, if ABC Company purchases equipment for $10,000, this equipment now becomes an asset, something that will contribute to the company's future earnings. Next, we have liabilities. These are obligations owed by a business to external parties. It's the money going out of your pocket. For example, if XYZ Corporation borrows $50,000 from a bank, this amount becomes a liability. It's something the company needs to pay back. Then comes equity. This represents the owner's residual interest in the assets of a business after deducting liabilities. Imagine John, who starts a sole proprietorship by investing $20,000 of his personal savings into the business. This $20,000 represents his equity in the business. Moving on, we have revenue. This is the income earned from the primary activities of the business, such as sales of goods or services. If ABC Company sells products worth $5,000 to a customer, this $5,000 is recorded as revenue. However, earning revenue often involves incurring costs, which bring us to expenses. These are costs incurred in the process of generating revenue. For example, if XYZ Corporation pays $2,000 for rent for its office space, this $2,000 is recorded as an expense. Accounts receivable and accounts payable are two other crucial concepts. Accounts receivable represent amounts owed to a business by customers for goods or services sold on credit. On the other hand, accounts payable represent amounts owed by a business to suppliers or creditors for goods or services purchased on credit. For example, if XYZ Corporation sells products to a customer for $1,000 on credit, this $1,000 becomes an account receivable. Meanwhile, if ABC Company purchases inventory worth $3,000 from a supplier on credit, this $3,000 becomes an account payable. So there we have it. The basics of business accounting boil down to these fundamental concepts: assets, liabilities, equity, revenue, expenses, accounts receivable, and accounts payable. By understanding these, you'll have a clearer picture of how businesses manage their finances, what they own, what they owe, and how much they are making. Remember, a strong foundation in these basic accounting principles is crucial for effectively managing the financial affairs of any business. It's like having the right pieces to complete your financial puzzle. So next time you wonder about business finances, think about these building blocks.